morning, Trinidad and Tobago, and welcome to the Bourse Report. But today we're taking a look at the banking sector, and we're looking at two of those Canadian-owned banking franchises operating within the Caribbean region. We're talking, of course, about FirstCaribbean International Bank, as well as CIBC FirstCaribbean International, and Scotia Bank Trinidad and Tobago. Now we're taking a look at their financial results for that 9-month fiscal period ended July 31st, 2021. Both banks would have reported lower revenues, but posted higher than expected or higher earnings per share or financial results over the previous comparable period. How did they manage that? Let's take a look. And firstly, we're going to turn this to Scotia Bank Trinidad and Tobago Limited, and we're looking at their earnings per share, which was $2.62 per share, a 26% increase from the $2.08 per share recorded in the 9-month comparable period of fiscal 2020. Net interest income was down just around 6.1% from $988 to $928 million. Overall, total revenues were down just around 3%, and that was offset by some increases in other income. We'll discuss that shortly. Net impairment loss on financial assets actually decreased fairly significantly, which is a positive for the bank's financial results, from $210 to $65 million, and overall, those earnings attributable to shareholders increased from $366 million to just about $462 million, a 26.1% increase. Now, let's take a look at the revenue trends of Scotia, and it hasn't been quite as good reading as shareholders may have liked to see. But again, take it in the context of COVID-19 impacted fiscal 2020 as well as 2021, with 4.3% decline in revenues over that 9-month period of 2020, followed up by a 3.1% decline in revenues in that fiscal 2021 9-month period as well. As mentioned, net interest income declined just around 6% from $988 to $928 million. There was an increase of about 5% in other income from $356 to $375 million. One of the interesting trends or bucking of the trends that has taken place with Scotia recently has been an increase in its total asset allocation towards investment securities, including treasury bills, which would have grown from its average of around between 20 to 22% over the last 4 comparable periods across 9 months, 2017 to 2020, to just about 26% in the most recently concluded period, that 9-month period of 2021, ballooning from an average of between 5.2 to 5.4 billion in the prior comparable periods, now having grown to just around 7.1 billion. And that has been attributable to, I guess, more or less active lending, and we could see that loans and advances to customers would have declined from 17.3 billion to $16.5 billion over the prior comparable period. So some changes, or one notable change rather, for Scotia in terms of its asset or total asset composition, being that fairly significant increase in allocation to investments relative to its total assets. Now, at a price of $61.50, Scotia is trading at a price earnings ratio of 17.6 times, which is below the current sector average of 22 times, but take that with a pinch of salt. Banking sector multiples have expanded quite significantly in the past 12 to 18 months or so. The bank does offer a fairly generous dividend yield in relative terms of 4.3% compared to the banking sector average of around 2.2 to 2.3%. So on the basis of marginally lower revenues, improving operational efficiency, and they would have curbed their expenses to some degree, and those consistent dividend payments, of course, Bourse is going to maintain a neutral rating on Scotia Bank for the time being. Turning quickly to FirstCaribbean International, or CIBC FirstCaribbean, the bank would have posted, again, for the same period as at Scotia Bank, an earnings per share figure of 38 cents TT dollar equivalent, which was a very welcome improvement from the 19 cents loss per share recorded in the prior comparable period. Now, like Scotia, total revenues were down, but for FCI it was a little bit more pronounced, a 6% decline from 2.9 billion TT equivalent to 2.76 billion. Operating expenses fairly stable, just a marginal 1.5% decline from 2.04 to 2.009 billion TT equivalent. The big game changer for FCI in this particular fiscal period was that very sharp decrease in credit loss expenses on financial assets, which decreased from 857 million TT equivalent to just around 102 million TT equivalent, leading to income attributable to shareholders of 592 million TT equivalent, compared to that loss of 294 million in the prior comparable period of 9-month 2020. Again, for FCI, we see that in terms of revenue trends, there has been a consistent decline over the past 2 comparable periods in total revenues, again, reflecting a similar experience to Scotiabank Trinidad and Tobago, with revenues falling both in its operating income segment, in that sort of future pink, from 955 to 907 over the past 2 comparable periods, as well as net interest income falling from 2.15 billion in the 9-month period of 2019 all the way down to 1.86 billion in the fiscal period of 9 months 2021. When we take a look at this profit by segment for FCI, we can see that there has been some recovery in terms of its banking business, swinging from a loss in terms of its retail and business banking of 209 million in that blue segment to a marginal profit of 41 million TT dollar equivalent. The corporate business banking segment also improving from 375 to 555 odd million. Wealth management taking a little bit of a dent, falling in terms of profit before taxes from 110 million TT equivalent to just around 20 million. Now, at a price of $6.60 on the Trinidad and Tobago Stock Exchange, FCI is trading, well, it doesn't trade at a positive trailing price to earnings ratio, but at a market to book of just around 1.5 times. And it offers investors a dividend yield of 1%. The bank has been fairly cautious in terms of distributing dividends over the past couple reporting periods on the basis of slow regional vaccination rates or slowing regional vaccination rates, stabilizing financial markets, which should be good in terms of expected credit losses on financial assets. But again, overlaid by general economic uncertainty, Bourse is going to maintain a neutral rating on FCI for the time being. Well, that's it for this week's edition. For more information, you can give us a call at 226-8773. Email us at invest@boursefinancial.com and check out our website at bourseinvestment.com. And of course, you can catch this article in today's business section of the Bigger, Better Trinidad Guardian newspaper. Stay safe, everyone. Get vaccinated, and see you next week on the Bourse Reports.